Welcome everybody to day 18 of the 30-day Trader Induction. This one is on market structure. Now, market structure is quite important. I'd say it's probably one of, if not the most important way in which we can interpret the movement of the markets, because whilst candlestick formation is great and support and resistance is also great, it doesn't give us the necessary context on where price has been and where it is expected to go. While it can to some degree, market structure gives us a bit more of a story and a more stable expectation on what the price is expected to do. So if we just start with the idea that we've got a level of resistance and a level of support, and we've also got an additional level down here, we've got a few different levels that the market will trade up against, hit its head, maybe break above, retest, and then hit the next level of support and resistance. We know that price is moving away from and towards different levels of support and resistance, and will oscillate between these as extremes and then reverting back to the mean. So support and resistance will give us the areas in which price is expected to reverse and turn away from, as well as additional price points that we can project out into the future based on the prior history. And candlestick formations allow us to time those entries from these support and resistance areas that we can then trade into the next ones. But what market structure allows us to do is actually build a bit of a narrative as to how price is moving into these support and resistance, and is also kind of the foundation that these support and resistance levels can be plotted on top of. So we're taking it a step further. Now, market structure is this idea of the market moving in higher highs and higher lows, higher high, higher low. And we've also then got on the inverse a series of lower lows and lower highs like this. And this is the trending markets. So we have a bullish trend and we also have a bearish trend. Now, a bullish trend is higher highs and higher lows. So I'll quickly mark these out. We have a higher high, then we have a higher low, and then we have another higher high, and we have another higher low up into a higher high. Now on the inverse, we are looking at the lower lows and lower highs. So we'll start with the lower low, and then we'll have a lower high. And then that will be projected down here and the lower low here. So what we're doing is we're looking at the swing points of the market, of the market structure, to determine what the trend is and the expectation of where it can go from and to. So a trending market is moving up in higher highs and higher lows, and the only way that we know that this higher low is a higher low, and in fact that this swing doesn't come down deeper, is only confirmed once price breaks through that recent high. So the market moves up, breaches the recent high, solidifies the higher low, and then moves up into a higher high. And now what we're waiting for is for price to pull back into a higher low and continue that trend to the upside. We don't know that this is where the market will turn around until the market moves back up and breaches through these highs and continues to the upside, that this is a solidified higher low. Now, that's the expectation that the market structure allows us to have. But if we now take the support and resistance techniques that we learned in the last video, we know that these regions of higher highs and higher lows, these swing points in the markets, are also correlated to the support and resistance levels. They can be used as support and resistance levels. So you can either look for the market structure and then plot support and resistance based on that, or look for market structure, or look for support and resistance and then try and apply market structure to it. So you can have it from different perspectives. So the previous higher high that gets breached by price to the upside, we know was a level of resistance once. It was broken through, so now we know that at some point it's probably going to revert back to this level, and then we can take the continuation trade off of that level. And we've also got the additional confluence on top of it, that this is in line with the expectation that the market structure, given that the market is in a trending market to the upside, a bullish market structure of higher highs and higher lows, we have two confluence factors. We have the trending market and the previous resistance now acting as support to position ourselves for a move to the upside. Now, that is the same as on the inverse. When we're looking at the trending markets to the downside, we don't know how far price is going to pull back against this and solidify a lower high until it comes down and breaches that lower low. And then once we've made the lower low, we know that it's likely that the price is going to come and revisit this lower low to form its lower high before then continuing to the downside, where we're able to position ourselves in a position at that lower high here down into a nice bearish run. So the expectation is that the market is going from lower low to lower high to lower low to lower high. Then we're going to go again down into another lower low, and that's trading with the trend. Now, another thing to note with the market structure, we are able to identify the changing of the market trend based on whether or not these swing points are respected or breached and invalidated. So in a bearish trend with lower lows and lower highs, what we do is we take the swing high of the lower high and we take the swing low of the lower low, and we're looking at price currently trading within this region here. And at this point, this is where price can trade all the way up to the lower high, reject that as resistance, and then continue low, and that will still be part of a bearish market structure so long as price doesn't breach through the lower high, the previous lower high, and then that would be signaling a trend change because the market has made a higher high relative to its previous lower high. So that would be a trend change. Now, these positions in the market up here where we've got a prior level of resistance, which is also a lower high relative to market structure, if the market is pulling back into this extreme, there's oftentimes a lot of fuckery that happens here, and the false breakouts, catching people on the wrong side of the market, expecting the market to shift and move back to the upside because we've breached the lower high, catching people on the wrong side, faking out and coming back below that level, and actually just continuing along with the lower high and the bearish trend. So that's just something to be aware of, that those points here are often quite very fantastic area to trade off of, because you've got the expectation of the lower high being formed to continue into a lower low, but also because you've got the support and resistance level, and it's also a point where if you can catch a fake false breakout and the market swept these recent highs, it's a very strong position. It's a very strong confluenced setup. Now, that's pretty much it in terms of the trending market. Now, just touching briefly again on the shifting of the market, we know that in order for the trend to be invalidated, i.e. go from a bearish market structure into a bullish market structure, what needs to happen is the previous lower high here in this downwards trending market needs to be breached. So we've got that lower low printed here, and now what happens is price breaches through this recent lower high into a new higher high, and that is now a trend change confirmation. We've got a trend change here. So what we're able to do is take an expectation that the market's probably going to revisit this recent lower high because that was a level of resistance broken, now acting as support. We can look to take that first retest of the position of that level to then take that next wave to the upside, because we've now gone from a bearish market structure into a expected bullish market structure because it's switched from bearish to bullish as it broke through the lower high of the bearish downtrend, that last one. We're expecting here to be a higher low forming, sorry, my apologies, a higher low to then take us into a higher high. So in this case, we'd be looking to capture that first higher low to take us up into a higher high as that trend has become exhausted as a bearish trend and now switched to a bullish trend. So that's a really good way to identify when the markets are shifting. We're going to be trading bearish with the lower lows and lower highs. And then once we get that breakout into a new higher high, the trend is now bullish. We need that first lower high, higher low confirmation before then confirming the next trend is to the upside. Now, in this case here, we can have the higher high, and so long as it comes down to this lower low at this extreme, if it holds at that extreme here at the lower low, let me just get the highlighter. If it holds that level, it is still possible for it to then continue all the way back up into a new higher high. And instead of it being a higher low, it's just a double bottom. And this is where we're going to get into the price action patterns a little later, but that is a double bottom signaling a shift to the upside. So we had the trend change breakout, higher high. We've gone from bearish to bullish. It's pulled all the way back down to the double bottom. It's stayed above the previous lower low, so it hasn't then shifted back down into a bearish trend. It's still holding on to this extreme, and it's still a valid bullish setup. Now, if the market just came all the way back down and printed a lower low, even though the breakout occurred up here and it's technically a bullish trend, it's now made a lower low, and this was just a fake out up here at this higher high. And that's just unfortunately what the trading is. You never know when the market is actually going to do what it's going to do. We're dealing with probabilities, and even though we had a breakout and it's a bullish trend by definition, doesn't mean it's going to hold. So that is just something to be taken into consideration with all of this. Now, again, like I said, the market structure in conjunction with the support and resistance levels are very solid because you have the expectation of market structure playing out with you into the story of where it's going to go. We're trading with the trend, and we're also able to identify when the trend ends. We can then take those swing points to layer on top the support and resistance. Now I'm going to use this as a nice little example here because this was a trade I took today or yesterday, or the bot took, and this is a really good idea of how the market is shifting and trending. So as a nice little exercise, what we can do is we have a run up into a high, we have a higher low, we have a higher high, price pulls back, kind of stalls, and then makes a lower high, and then a lower low, a lower high, and now a lower low. So what I'm going to do is put this on the line chart because this will make it a lot more easier. That's a nice little hack. You can use the line chart to identify where these swing points are. Now, notice that I'm not using any of these like little tiny ones. What we're looking for is those extreme swings. It's a bit of a discretional approach. It's not really quantifiable, but it's something that can be identified subjectively, and that's where the human intuition comes in very well. So we're looking for those major swing points of the markets across all different time frames. Now here we have the higher low, we have the higher high up here, price then prints a higher high, and we've got down here a higher low. But what happened is this wasn't actually signaled by being a higher low. It hadn't been confirmed yet because price didn't come up to the recent highs and validated that as a higher low. What in fact happened is the market failed early, and it just formed a lower high and then formed a new lower low down here. So we didn't know that this would be a higher low or that this would fake out. So whilst price is within this range here, we're just waiting to see what's happening. And instead of it continuing to the upside as a new bullish trend to the upside in a bullish market structure, it broke down. So this lower high then became confirmed as the market broke down through the level. So as the then price came down from here, set a low, lower high was confirmed as price breached that low and down into a lower low. So in the moment, you kind of have to stay up to date with price and be watching where it's happening, because you've got an expectation that the market's going to continue to the upside because it's making higher highs and higher lows. We're expecting a higher high to confirm this whole higher low, but what happened is it failed, which invalidated the bullish trend. We're now bearish. That's the lower high because the lower low, the previous higher low was breached. So then what we're able to do is now that it's shifted, we didn't really have confirmation that this was a lower high because it hadn't broken down through the previous lows. It was just kind of in no man's land. What we can wait for is that first lower low to confirm. We're now in a bearish trend, and we can take that position short, taking the first lower high into the downside. Now, if I just go back to the candles here, notice that price didn't pull back all the way up to that region that we were looking at. That is just unfortunately the name of the game. it's not always going to pull back up into that previous point of market structure, but it's a very good initial like inflection point. Now the strategy that I trade takes the 0.382, which in this case was just a lot further lower. I did take this trade, and there is a time and a place to trade when it's not at the recent structure, but it's again just more of an identification and a framework on how to view markets trending. So that is the video all wrapped up for market structure. Thank you very much for watching, and I'll see you in the next one.